Hi friends, very good morning. In today's video, I will be briefly covering about the Indian financial markets. Please note that this is a free educational video purely for the purpose of learning. This should in no manner be considered as any kind of an advice, offer or promotion to sell anything. Information here is solely for the purpose of investor education. Okay, friends. So let's start with the Indian financial markets. And the Indian financial markets, let's talk about, let's say, currently what the investor may be thinking at this moment when the Indian equity markets, especially the Nifty, is trading at 18,700 level. So what next? Well, if you were to ask me, my answer would be, I don't really know what needs to be done. Okay, so let me give you a perspective and share a couple of pointers. So let's understand that the Indian equity market has been currently, I've taken 20-year data from sources, just let me pull out that data. From 2003 January till January 2023, that's right, the Nifty has given a compounded return of approximately 17%. Now, coming to another asset class, which is gold. For the same period, gold prices in rupees have given about 11% compounded. And for the similar period, debt. Now, what I'm talking about debt is, one second, CRISIL, short-term bond fund index has given about 7% compounded return. Okay. Now, what does this tell us? Of course, that if one were to look at a higher or a longer period, the aberrations get evened out. And of course, there is no guarantee that historical returns are any barometer of future returns, which the investor must make it very clear in his mind for investing. There is no guaranteed return in any asset class, be it equity, debt, gold, or for that matter, any asset class. So investors should make a decision keeping this in mind. Okay. Now, what I was coming to was that investors may ask that what to do at current level. So this is a very difficult question, but I've shared the historical data. And if you look at longer period of time, the chances of getting a better risk adjusted returns increase if we increase the period and we go into multiple assets, so like equity, gold, debt. Now again, I'm not saying anything like what an investor needs to do is entirely his call, depending upon his risk profile. He needs to understand and chalk out what would suit best for his overall risk and accordingly invest into assets that suit his requirement. So, coming to the point, we should not have a short-term vision that at this level 18700 what needs to be done in the Indian financial markets. Rather, we need to look at overall period for a longer duration. And coming to the point, we are talking about all this data that I have shared is only about the Indian markets data. So investors in India need to understand this and also keep in mind that chances of getting a better risk adjusted return increase when the period and the assets are multiple in nature. Of course, there is no guarantee of any kind of returns in any kind of financial markets. This is a bold statement. In bold, keep in mind clearly no guarantees. Investor needs to do his due diligence while investing, and of course, follow all the steps which investor needs to do, keeping his overall goals, his risk profile, and other relevant things while reaching at any investment decision. Thank you very much, and I hope you like this video and take care.